Assalamualaikum warahmatullahi wabarakatuh. I'm Tsabitah Elza Silwanty with NPM 2151011008008. And this is the second part of English assessment. I will start. Financial hydrocarbons, fossil hunters. How buys the dirty energy asset public firms no longer want? It could be your university or passion fruit. The first law of thermodynamics states the energy couldn't be created to the storage, just transfer it from one place to other. The same seems to apply to the energy industry itself. Pressured by investors, activists, and government, the West's six biggest oil companies have set $14.4 billion of mostly fossil fuel assets since the start of 2018. The industry is eyeing total disposal worth $128 billion in the coming years, say Wood Mackenzie. A consultancy last month, ExxonMobil said it would divest its Canadian shale business, shall put its remaining Nigerian oil field on the block, but most of the time tests out mode on it until it are not being closed down. Instead, they are moving from the folded world of leasing market of Saudi surroundings. Money are ending up in the hand of private equity firms. In the past 2 years alone, this bought $16 billion worth of oil, gas, and coal assets towards 5,000 transactions, a third more than they invested in renewable sea-chart. Some have been multi-billion-dollar deals with giants such as Blackstone, Carlyle, and KKR, carving out Hawk oil field, coal-fired power plants of gas grids from Energy Group, miners, and utilities. Many other deals sold by similar rivals get little public. This sit uncomfortably with the credo of many pension funds, university, and other investors in private fund. 1,485 of which representing $39 trillion in assets have pledged to defy fossil fuels, but few seem ready to leave juicy returns on the table. PIC love averred will oil is not now, but between 2002 and 2015. Rising global demand for the fuel posed in price above $100 a barrel, prompting fund focus on upstream asset exploiting and production, especially fracking well too much room. But then Saudi Arabia and its allies agreed, causing drilling firms to go bust and deals to soar. Buyout fund targeting fossil fuel posted 10 years internal rate of return IRRC of minus 0.7% at the end of June 2022. Rockans breaking a data frames, but the wind had failed as demand for oil and gas peaked while dwindling investment in production limits supply. Prices are rising again, boosting produce profit. BP, for instance, raked in $12.8 billion last year. The month since 2013 Shell predicts IRRC of 10% of investment in upstream projects, again 10% from renewable ones. Buyout funds, which often have a 10 years life, can hope to make their money back in half the time, most of it from the operating cash flows the acquisition generate rather than from reselling assets. They can source capital cheaply, in contrast to the major, which have an annual cost of equity of above 10%. They capitally finance energy deals with 8% debt at interest rate of 4 until 5%, and discount imposed on brown assets by the stock market linked to sustainability focus rather than financial owners, the causing a lot of mispricing on which private funds thrive. PI managers have also been keen in changing their strategies. Many are no longer marketing energy food, except those with a focus on renewables. Instead, upstream assets are being lumped with other into funds labeled growth or opportunistic, which cover a range of industries. Private debt funds snap up oil and gas loans from banks. The biggest hit has been a swap on mainstream assets by private infrastructure funds because their revenue are contract and paid for by big clients, energy major and utilities. They are demand very safe, while also generating attractive IRRC in the high teens. Some firms do everything. In June, a fund manager owned by Brookfield, which is based in Canada and acquired joint ownership of the entire portfolio on North America oil and gas loans of ABN AMRO, a Dutch bank. In July, Brookfield agreed to pay $6.8 billion for Canada Fund's largest pipeline company, a day after touting a $7 billion fundraising round for a green transition fund. PI firms say they can be trusted to manage those assets well because they want controlling stake and escape the context gas of public markets. They seem themselves as being in a unique position to improve efficiency and reduce emissions. But the incentive of pocket defendants first and worry about the rest later are going. Global private capital, dry powder. Money reset by funds that has yet to be spent has hit a $3.3 trillion record. With so much to spend, managers want to do a lot of deals, which in turn means money don't have time to craft considered decarbonization plans for asset. Investors seem is not rushed to tighten the tabs. A range survey by Probitas Partners, which help private firms raise funding vehicles, show investors have almost no appetite for oil food today, but few have policies that exclude cash transaction by border funds. Using data from PAI Media, the Economist has looked at 8 PI firms that have closed fossil fuel deals in the past 2 years. The investor in some of their last energy flavored vehicles includes 53 passion food, 23 in universities, and 32 foundation. Many are from America, such a teacher retirement system of Texas, the University of San Francisco, and the Precared Traubert Foundation, but they is partly because more institutions based the disclosed PI community. The list also filters Britain's the West Yorkshire passion food and China life. Some investors may decide to opt out of funding their portion of fossil fuel deals, but a third, yet more opaque class stands ready to step in. State-owned firms and suffrage funds operating in the shadow. Last month, Saudi Aramco, the kingdom's nation oil company, acquired a 13% stake in a refinery in Poland and Somoil, and an Angolan group bought offshore oil assets from French Total. In 2020, Singapore GIC was part of the group that paid $10 billion for a stake in a Emirati pipeline. Cold banks act as a restraining force. Big leaders in Europa are soon to face green stress tests. Many have announced net zero target. Their appetite for upstream deal is diminishing rapidly, say a Wall Street banker. Yet for big deals, bond market remain open. Smaller deals can tap private debt markets. And although Western banks soon allow to midstream project, ASEAN owners do not. Liquidity still abound. Last month, a group of investors led by AIG and American buyout firms hired Citigroup and JP Morgan Chase to help it refinance the $11 billion loan it took in June to buy Saudi pipelines. No matter how deep you get into the capital structure, the laws of thermodynamics still seem to apply. Thanks for you listening my reading. Thank you.